Hello and welcome to everyone participating in today's webinar, exploring the OMB update, revised uniform guidance to CFR 200. My name is Yevgeny Sahenko and I'm a senior controller with GRF CPAs and Advisors, formerly known as Gelman, Rosenberg and Friedman, and I will be today's moderator. So before we jump in, some quick housekeeping items, just so you all know what to do to earn CPE credit. So everybody that's interested in CPE credit must complete and submit a short evaluation survey that we're going to send out after the webinar. You're going to be asked to recall CPE words that we'll be providing during the webinar. So please write these words down when they're given and keep them until you have your certificate, as they will not be provided again. And if you have any technical questions or issues during the webinar, please use the questions function to speak with the webinar administrator for assistance. And also the slide deck and the recording from the webinar is going to be available for download at the link shown here. And you'll also receive a follow-up email with direct links. And again, any technical support or CPE questions may be addressed to Nathan McElveen at nmcelveen@grfcpa.com. So with that being said, today's learning objective is to provide all of the attendees with an overview of the updates to Uniform Guidance 2 CFR 200. And with that being said, I'd like to introduce your presenters for today. Paul Calabrese is an outsourced accounting and advisory services principal here at GRF, and Trisha Catabini is a senior manager in our audit department. Paul, I'll hand over the presentation to you now.
Thank you, Yev. I appreciate that. So just the sources here are basically, there was a recent update dated August 13, 20 in the Federal Register. And there's a red line version, which we'll also post with the PowerPoint. And you can actually compare the language between the old and the new. So that'll be available for you as well. So today's discussion is our session is gonna focus on a lot of what I would call little things, formatting things and changes. It's kind of like, from what I recall, some of the things that should have maybe been in the original version that they finally got to in this version. Plus there's some updates as far as ASC 842, as far as labeling the correct name, taking out capital type of leasing to finance leasing. And also there'll be new things like some restrictions with Huawei, ZTE, and the new cost principle, who you can deal with, who you cannot deal with. But before I move on into the revision things, one of the important things is that instead of the word CFDA, Catalog of Federal Domestic Assistance, they are removing that phraseology and just calling them assistance listings, which you can find at www.beta.sam.gov. And in there, that's where you'll find all the various programs. There's a search engine that they have that you can use and find the program, it gives you a lot of things, what the compliance standards are and the funding that might be available for a current period. So that's something you would definitely want to look at. But there is, in this new upgraded version, they wanted to segregate and clarify period of performance, the must versus the should, which we'll talk about, tremendous emphasis on performance and outcomes. And we talked again about prohibitions and public policy. There'll be a thing about a domestic preference that we'll talk about, management decisions with your pass-through entity, that's PTE, and subrecipient. SRE is subrecipient entity. It's something I put in shorthand so that our slides wouldn't get too long. And there's a big issue there about direct funding and the impact on requesting indirect rates for subs. Specific guidance on closeouts, documenting procedures. The biggest changes are to the procurement standards and an important change to the NICRA. And before I go on, I just will wait each time just if Trisha here would like to chime in on anything.
Go ahead, Paul.
Okay. So this slide is the only slide that we would call conjecture slide. And it is a slide that, because certain information has not been provided to us yet, as far as like for audits and when they might take place. We just thought we'd kind of go through the way they did that originally when they brought out the OMB uniform guidance in the beginning back in December of 2014. So basically, the effective date is November 12th, 2020. So what may happen for audits, because we know that audits are full year and the effective date is again November 12th, 2020. So it may be that those audits may not be applicable until a full year starting, January 1st, 2021. So our year end of December 31st, 2021. And then if you have a 630, you're talking like, July 1st, 2021 to 6/30, 2022. So we don't know about that. We think that might be the way it'll be rolled out, perhaps through a compliance supplement. And Tricia can certainly chime in about if that would be a place that they would put it.
Yeah, I think that's kind of what we're expecting in the audit side as well. When it comes to some of these updates, I would not expect that my 12/31/2020 year ends or would have any of these requirements updated and applicable for their 2020 single audits that they would have to be performed. So not sure what we'll be looking for, what we'll be looking at when it comes to the timeline, but I do know that we're still waiting on one compliance supplement addendum for the current year for the 2020 compliance supplement, but I don't anticipate that this information will be in there quite yet.
Cool. So, and then as far as new awards, it's going to be pretty much similar. And we'll go into that in a minute, but it would become effective basically once the new award. So if you get a new award and it happens to land on November 12th, then the new rules will go into place. And obviously if it's before 11/12/2020, then obviously you'd be under the old standard. So we'll move along there. They did address, interestingly enough, the impact on NICA rates and cost allocation plans. And what they're saying is that what you have in place is good until they expire. And then if you get a new negotiated rates, doesn't really matter. I mean, even though they're for full years, really what they're saying is the date you negotiated, if it's 11/12/2020 or later, then you would follow the new ones. And that would apply for cost allocation plans. And again, they made it very clear that revisions to CFR are not applicable to awards prior to this notice. And apologize. Do you want to speak to that?
So, well, I think some of the things that we're looking at right now on the audit side, at least, is there's been some obviously changes because of the CARES Act, right?
Right.
So as far as what we know so far, again, we are waiting for an addendum right now that should have a little bit more available information, but the AICPA government, excuse me, Governmental Audit Quality Center has issued at least something for us right now that we can go by to kind of talk through what is subject specifically to a single audit as far as federal assistance goes and what should be included on your CFA. And it's a nice little matrix. So if anybody is interested, I can most certainly point that out to you. Feel free to email me after the presentation. My contact information will be included on the slide at the end. But one of the other things to just be aware of as an organization who receives pass-through funding from the federal agencies is that anything that's coming through that is in light of COVID now must have a prefix or a preface on the CFA and must be specifically and separately identified on the CFA, even if it's coming from a same agency or even a same grant. So for instance, if you received $500,000 on a specific grant, and then come April or May, you received an additional $25,000, you would have to specifically identify that separate $25,000, even if it was a modification to the same grant award, that it is specifically related to COVID. And the preface is very easy. You literally would list it the same as you would as any other program, but in the very front, you just say COVID. So that's what we know as of today. The compliance addendum for 2020 was supposed to be issued in mid-October. We are now sitting here on October 15th. We've not yet seen word that it has been available to us. So for those of you who are under a June 30, 2020 year end, we're still waiting.
Okay. Thank you, Tricia. We appreciate that. So let's talk about the period of performance. So the government became concerned that certain things would be inserted so that we wouldn't take for granted or assume certain things, like with the period of performance and certain specific date. And we see this happening a couple of times with the update, so that apparently there must have been issues in the past and they're like very specific clarifying points. And one of them clearly was the period of performance. So this is just the general time interval from the beginning to the ending piece of it. It can include one or more funded options. Sometimes grant awards are one period, sometimes they're multiple period. But this period of performance statement does not deal with the actual funding. So there we go, and that pretty.
Yeah, and I think, Paul, from my perspective as an auditor, when OMB issued the uniform guidance and it originally came out back in 2014 and became effective, this was something that we all struggled with. Auditors struggled with it. I think organizations struggled with it, understanding exactly what period of performance was. And then we as auditors, what are we really testing for as far as the cutoff and end dates and beginning dates for specific awards. So from my experience, we've been auditing period of performance depending on basically what the organization has been saying, or asserting to, I would say, because we don't know, is it the budget period? Is it the performance period? Because, those grant agreements outline multiple different types of periods that we're adhering to. So we've always been more conservative in our approach so far. We've always been auditing against a budget period normally. So I'm personally, as an auditor, very excited about this piece because it's now more clear, much more clear to us now what we need to be auditing for.
Fantastic. So along those lines, now they not only talk about the general performance periods, but the budget period. It is the budget period that now we're talking about that requires or relates to the actual funding. And it not only includes the actual funding, but also any carry forward monies as well. And carry forward monies, in my opinion, and figuring that out and being ready to get that purposed and approved by the government is a very, very important thing. Okay. There we go. There we go. So renewal period is pretty much just another period. Can follow obviously right after a prior federal award has expired, but it's also a distinct, start and end date. So again, they have, as you can see, the government has gone through, just like Tricia has said, to make it very clear for auditors and for those operating these grants to know what the differences are. And in fact, the reason why I put this small citation in is this is information that should be contained in a federal award. And since we now described the budget start and end date as being the funded amount, how clear that must be. And that would also apply especially for those of you that are pass-through entities to your subs. You would want to make this very clear as well. And then it addresses future periods, periods that are option periods, periods that are beyond the basic period. And so they address those as well. And they could be multiple periods. I'm sure everybody that gets an award wants to have many, many multiple periods, but they are subject, of course, to availability of funds and your performance and are you complying, because the government will always be looking at that. So there we go. Further emphasis. And then there are modifications to performance period. And for this, we have the original performance period was just the statement. They would talk about, okay, this is the beginning and this is the end. And what they've done is they've added modifications to the period of performance. And so it's just talking again, being very, very specific about mods to the period of performance. And of course, if a termination happens, that's something entirely different. And it ends the award because it comes to an end. Also, I assume if you have a no cost extension, those things will be added as well. And a specific, again, renewal period, a specific and distinct period of performance will be added. So the government wants to make this stuff very, very clear. Pre-award. We understand that pre-award costs are costs that happen effectively like you get a letter, a contract, or a letter from the government saying, hey, we want you to get going. This is very important, timely, and we're going to give you a certain pot of money. And often it's just, not always, but often it's labor and fringe. And so you're given a limited amount of money, a limited amount of stuff to get this work done. But then there's always the question, where does that money fit in, especially if it's not specifically stated? And so the government, has made clear that it goes into the initial budget period. And then there's a situation continuing on with periods of publication and printing costs. And the non-federal entity during a closeout period might have certain costs of production and sharing research that results if the costs are not incurred during the period of performance of the federal award. So in this situation, this would go along with the final budget period. Obviously, there's nowhere else to stick this stuff, so you would put it in the final period.
Great, thanks team. And so with that, we've reached our first polling question. And our question is, which of the following statements is correct? Is it A, a budget period does not commit the awarding agency to fund the period, but does include the carry forward of cost? B, only the performance period may fund an award? Is it C, publishing and printing costs must be assigned to the initial period or else not receiving funding due to the closeout of an award? D, pre-award costs can and are funded before the initial period can begin? E, for all of the statements above are correct, or F, for none of the statements are correct. So while everybody's taking a moment to answer, again, I want to remind everyone that if you would like to receive CPE certificate, you're going to need the CPE words that are given. And our first CPE word is budget, B-U-D-G-E-T. Again, just a reminder, please jot these words down as you're going to need them for the survey following the webinar.
Interesting. Well, the 17% of you, the 5 that you have it correct, none of the statements are correct. So that's one of those ones. Now we'll move along. Let's see. So as we know, ASC 842 is coming into play. Before I go on, Trish, what is the actual time period that's been extended to for private companies and nonprofits?
That's a great question because obviously in light of COVID, it has been delayed yet another year. I don't know how many times they've delayed this at this point. I'm interested to see what happens in 2021. But currently this is effective for year ends 12/31/2022 or fiscal year ends in 2023. So next year you've got revenue recognition. If you didn't already adopt it, that's now required for 2021 year ends. And then a year after that falls for the leases. So, as Paul mentioned, this particular accounting standard update is related to excuse me, financing leases. And those leases are currently accounted for under GAAP as simply a deferred rent, right? For once you straight line it over the term of the lease. And then you would expense it relative to straight line expensing over that term of that lease on your profit and loss statement or your statement of activities for the not-for-profit world. And so what's going to happen now is that you have to put a right of use asset on your books as an asset for what is basically the present value of that lease and those payments. And then you would have an obligation or a liability also sitting on your books for those future obligations. So it's going to be a little bit of a nuance. We've early adopted a couple of them. And, so Paul, how is this going to be accounted for now under OMB?
Good question. I don't think anything actually changes. I think as far as, because OMB, we're dealing mainly with expenses. So I believe the process has pretty much changed. For this process, it's just going to be a labeling thing that instead of, like for nonprofits calling it a capital lease, you're going to call it a finance lease. I don't at this point foresee any differences. And if others believe it, so I'd sure like to know, but I don't believe there is. I think it's more, again, a labeling thing. And just like Tricia had said, the rental or lease payments, as she discussed, gets into what we call right of use or right to use lease asset, depending upon GASB or FASB. But right of use operating lease asset, which again, your balance sheets are going to start showing as you said, as asset and obligations. So, but because the uniform guidance doesn't deal with the balance sheet, they deal with the statement of activities and specifically expenses, then we may not see any real change except in labeling. But this is all important to know, these updates. And I'm glad that they're at least addressing this right now, regardless of, like you say, what year, future years these may come into play. At least this is a good opportunity to change, the labeling.
Yeah, and Paul, one of the questions that I think you and I were discussing earlier on this particular topic was whether it's going to be actual cash payments that can be applied, right, against the expenditures, or whether that's actually the expense that's recorded on the statement of activities. Can you give us some insight on that?
I don't have enough information on that now, unless you have information.
I think we're still trying to understand how this is going to work. That's, I think, kind of where we are in this update and what's really might change, right? So is it actual cash outlay? Because when we talk about expenditures that can be requested for reimbursement, typically it's cash outlay, right? So is it the cash or is it actually the expenses being recorded on the books? And currently there's not a big difference though, materiality wise, dollar wise in our world from the auditor's perspective, whether it's the cash or it's the expense side, because usually it's a very minimal trivial variance each year, because currently most of the clients I know do it based on an actual expense that's on their books versus the actual cash that goes out.
Yeah, there's nothing that, you're right, and that's a very good point. I have not seen anything. Let's hope that they address that maybe in a compliance supplement or something. There are very few situations, but there are a few situations where the cost principles address funded or cash, like, with retirement plans or something like that, or pay as you go with, those post-retirement benefits, things like that. And if it's pay as you go and you do pay as you go, well, guess what? That's just cash. Or even if you do it on an accrual basis, but they say you wait after 6 months, then it reverts to almost like cash when you make the payment and pay as you go. So there are a few examples in the cost principles where cash basis kind of becomes the expense, but not always. So what would you think? Do you think maybe this is something that would be addressed in a compliance supplement?
Again, it's usually so trivial. I don't know if we or even they would consider it. So I don't know.
Yeah. So these are things to be determined in the future. But again, these people don't have to get involved with it. Maybe that's another reason why the government will take its time in dealing with it, right? So you said 2022 or 2023?
Correct.
Okay. Well, improper payments are something that the government just wants to really deal with. In fact, you may not realize it, but there's a cost principle. And if you've determined that there was some form of improper payment, whatever it took to pay back the government, man, oh man, they want that money and they want it right away. And they'll support it as an allowable cost. But then in the definitions parts of the of this new revision, they wanted to make very clear, you know, what these are: overpayments, underpayments to eligible people. But it can be a number of things, and there's so many things that just kind of had to outline each one or underline them. You know, it's inappropriate denials of payment or service. You know, it doesn't account for credits or discounts, which are important. Payments that are of an incorrect amount, duplicate payments that were made to an entity, and an improper payment that's made for to an ineligible recipient or for goods and services, and or payments for goods and services not received. And doesn't stop there either, because the big issue is can the agency or the auditor on behalf of the government that's doing this work, can they really determine what this expense item really is because of lack of documentation? And in my world, perhaps not so much, and Tricia can talk about it, but when I was an auditor with the government, sometimes we call something we can't find documentation unsupported. But often if the entity cannot find that document, it became questioned or disallowed. And maybe Tricia can speak to, she says she's seen a lot of credit card charges.
Yeah, credit cards typically tend to be one of the biggest areas where we're missing expenses. But Paul, one of the other things that I just recently came across, which was a little bit different of a scenario, came with actually payroll costs. And one of the clients that we were auditing gave a pay raise to a part-time employee, and that part-time employee got paid for that specific pay raise amount. And the only reason why they got the pay raise was because they were going to be working 5 hours more pay period. And they ended up not working 5 hours more pay period, and actually ended up charging that amount still to the government, to the federal agency for federal expenditures. And so, you know, they were like, it's only $1.50 more per hour that she was paid. And our whole point was, but yes, you charged it for the federal government for basically a service that wasn't performed. She didn't actually work the hours. You know, so that's another thing that just to kind of think about and keep in mind in the back of your head as well, because, you know, HR, especially in light of COVID, and because this occurred during COVID, the specific instance, those are just the kinds of things to think about from a transactional standpoint as well.
So I guess, should we take the deep dive into that question that if you get PPP money, loan money, right? You certainly, if you've got reimbursed for a grant work, you know, then you can't really use the PPP money, I guess, for the grant, because you can only have one cost reimbursed from the government.
Correct. There's no double dipping allowed. And one of the other big questions that I think is still yet to be unanswered, and we are still waiting guidance on, which is a little concerning considering we're sitting here in October, mid-October for June 30 year ends that we've already started our audits on, is whether those amounts that are used for the PPP funding also get knocked off for your indirect cost calculation as well. So we're still trying to wait and see how that's going to happen and how that's going to work, because I know some of our clients, while they haven't been directly charging those salaries specifically to the grant, it is of our opinion that while you're not directly charging them, they still would not be included in your allocation for your indirects relative to, say, fringe benefits or something of that nature.
Yeah, because the allocable portion of the indirect goes to the award which you get reimbursed.
Right. So, you know, our opinion is that those should be completely separate and accounted for completely separately. And the other thing is, not only do you have to worry about the federal assistance, but some of our private funder grants also cover salaries, and we have to be very careful as well on those to ensure that we're also not double dipping there. Unless you have specific approval from the private funder, because I do know some private funders who have said charge both.
Wow. And I've seen, and this is just a general thing, and it's just, especially those of you who deal with foreign operations, like with USAID or Department of State, and that is, for some reason, I've helped with our clients, and for some reason, people lose the consulting agreements. And it may be because a lot of documentation was left at the foreign office, and then it was closed down, and those documents just disappeared. And then frantically later, they're calling these people who have moved on, who are consultants to the work that was performed. And sometimes they find them and sometimes they don't. It's just a good policy or practice, just that everything of that nature also be copied, and everything be copied to the home office. And then there's the issue, that once these things are determined as improper payment, they will be, a questioned item. This was in the FAQs, and they finally moved this into the regulation, which does make sense. When they use the word must, it's an absolute mandatory requirement. A should or a may is a suggestion of a best practice, but one often should listen to those shoulds as well, just as that's very important. Then we go into the emphasis, and I'm just going to move it along a little bit so that we have enough time to complete, but just you'll see in here the emphasis on measuring goals and objectives. And in program planning, you'll see the same thing again with clear goals and objectives. This is something that's very, very important. And in fact, you probably may have not read the little preface to the whole purpose, or one of the purposes of the revision, but the current administration wanted to focus, especially for the taxpayer, to know that what they're getting, there are outcomes, there are goals and objectives that result in positive outcomes. Or it may be a great study, but they may through the process, it doesn't even achieve what they needed to achieve. And so with being able to measure goals and objectives and outcomes and having meaningful results are very, very important. So again, we're measuring things based on goals and objectives. So you can see that basically what's happening is we're going to performance-based awards that are very important. And this section here just goes on and on and on, about using certain types of baseline data, collection, expected outcomes. If you were in the Ryan White world where you were dealing with HIV/AIDS, they do track the outcomes. They have systems like, one is called ARIES, I can't remember, CareAware is another one, and they're unit-based items because they know that accounting systems, or most accounting systems, don't track units. And they track these units so that they, and by different types of standards of care, so that they can show the types of outcomes and whether this is really working or not. It's very, very important. And it's often between the people that are doing the actual work, often are sub-recipients under a municipal arrangement. There we go. And here's just with the Department of Education. I've had the fortunate opportunity to work with entities that dealt with the Department of Ed, and this is the ED 524B. And it's something, again, where you can see they literally, because there's so much involved with this, you can see that they have standardization of like percentage of participating 8th graders who meet or exceed proficiency on state reading and language arts. And then they do the same for high schoolers. And so they've actually built this standard system in. So as you're doing something in this area, like pertaining to reading or language arts, there's a measurement process. And this is one of those examples. Well, I think it's pretty obvious never to contract with the enemy. And basically what they're talking about is a support of a contingency operation, which the members of the armed service are actively engaged in hostilities. And this would be for awards greater than 50,000. And we get into a new cost principle, and that's telecommunications and video surveillance costs. And this has to do with just exactly what this is stating: video surveillance services and equipment such as phones, internet, video surveillance, cloud services, services, and so forth. But now there are prohibitions against this, and we'll get into that in a minute. And so certain individuals, recipients and subrecipients are prohibited from obligating, expending loans, and that's with Huawei and ZTE. You've probably heard of this in the news. And so now the regulations are hitting down at what would be for you contract levels, where you have giving goods and services and dealing with this kind of information. I can't imagine a program having it, but maybe under a program, these issues come up. And so it just continues on. But they also are committed that should this entity, for some reason, let's say, have these prior kind of covered surveillance, telecommunications with ZTE and so forth, they're just saying there's a commitment for those entities to transition out of those communications processes to procure basically replacement equipment and services. And this is more to obviously the executive agencies administering this. With public policy, the one issue that's changed is a priority, basically, whether it be subawards or primes, basically to purchase and buy American. That's basically what it is, an item that's produced in the United States. You'd see a lot more of these types of statements in a government procurement contract, but now we're seeing more of this inserted into awards, federal assistance awards as well.
Perfect. Thanks, Paul. And so we're now on our second polling question. And this one is actually a true and false. So the question is, although there's a preference to procure goods and services manufactured in the US, we can also procure telecommunications, video, and surveillance equipment from the People's Republic of China per the new telecommunications cost principle, as long as we disclose and enter the transaction information in the FAPIS database at www.beta.sam.gov. So again, A for true, B for false. And while everybody's recording their answer, I'm just going to remind that if you would like CPE for this webinar, at the end, you're going to need to provide the 3 CPE words. And so the second CPE word is program, P-R-O-G-R-A-M. Once again, just a reminder, if you'd like CPE credit, you're going to need to provide the 3 CPE words. We're on our second one, and it's program, P-R-O-G-R-A-M.
Yay, 86% said it was false, and it truly is false. So you guys are really up on all that. Very good. With respect to pass-through entities, there have been new changes, basically in being more specific as far as written communication relating to the review of audits and on-site reviews, and now even written confirmation about subrecipient highlighting the status of actions planned. Issuing a management decision for applicable audit findings only apply to the federal work to the subrecipient. And I think what they're getting into here is what we'll see on the next slide is basically whether there are what we call, let me go to the next one, cross-cutting audit findings. And those would be, here's an entity and all of these issues apply to that particular entity, but you're a pass-through entity and you're only dealing with one of those issues. Maybe if I'm not confusing this a little bit, maybe Tricia, you could kind of chime in a little bit with this.
Yeah, you know, from my perspective, this is something as an auditor that we've been kind of on top of, I think, from the beginning to ensure that, you know, as a pass-through entity who has subrecipients, to ensure that you are doing your specific monitoring and you are adhering to this compliance requirements. And while they weren't as specific as I think that they are now, you know, we have been instituting with our clients to ensure that they have best practices in place that actually comply already with this new update. So, you know, I think that most of the organizations we currently work with are here. And, you know, as you say, again, it's kind of like when we have, you know, a subrecipient who has performed a single audit and it's an overarching issue. Again, that applies to when we see on the Uniform Guidance Report, all federal awards, you know, we're not specifically honing in on that one because it's an overarching thing. But if there is a specific finding that is relative to their program that our pass-through entity, our client might have, then we're really making sure that they're monitoring and working with the subrecipient to ensure that they've become into compliance with that.
Okay. And basically, though, even though, you know, others may be looking at it and you may not, as a pass-through entity, have the responsibility for other items that apply to your specific subawardee, you still have the requirement, of course, to manage them and monitor them as well. So here is something that is probably sad news for people, and really what it's getting into, and it's almost the deductive method, because I don't know why the government just doesn't flat out say it. But basically, it's saying if the nonprofit does not receive any direct funding from the federal agency, then the pass-through entity is responsible for negotiating indirect rates. We already know this. This has been in process since the beginning of the uniform guidance. But what they're trying to emphasize here with the direct funding issue is that you cannot go to the prime if you're a sub and all of your funding is pass-through money from someone else. Yes, it is federal money, but your relationship is with your prime. It is not directly with the federal government. Therefore, you cannot go to the federal government and request a negotiated indirect cost rate. The only thing you can do is try to find a prime award, no matter how small. Have you experienced this too, Tricia, with some of your clients?
Not directly. Most of ours
Okay.
have some kind of direct funding and have been working again with their cognizant oversight agency for this. So
Okay.
I haven't seen it specifically, but I do have ones where they have subrecipients who only receive funding, pass-through funding from them. And so their subrecipients don't have a negotiated rate with the federal agency specifically. They have it with them.
Okay. And then basically, there is discussion, you know, as far as, well, who handles all of this? The agencies, as far as indirect rates, it basically is going to be the cognizant agency. It's going to be the cognizant agency and their division of cost allocation services, whether they handle it, as far as having the greatest dollar volume. And unless as they're saying here, there's some kind of shift, you know, you basically have to stay with one entity for a while, because it's amazing as I'm talking with people, some of our clients are saying, well, we'd like to work with this agency or we'd like to work with that because we're better aligned with our programs. But it really depends upon the volume and so forth. And they don't want to change it too often. And then there's the oversight agency for audit. And Tricia, you know, it probably almost a similar type of approach, right?
Yeah, absolutely. You know, so those that they get the most direct funding from whichever agency tends to be their oversight agency. And I see a lot of the monitoring, and if they do have findings, a lot of the monitoring comes directly from them as far as the audit findings go, and ensuring that they've got the corrective action plans in place or actually performing the corrective actions to get them back into compliance.
And then with closeout, we get back into the same thing we saw with the period of performance. The government wants to be absolutely clear as far as whether it's a pass-through entity or a subrecipient, you know, that they follow their obligation to provide all the closing documentation that's required. And of course, you know, there's gonna be a real problem if an entity fails to complete those requirements. And they'll talk about that later, but the point is, it's very, very important to do this because it's a timely process. And you'll see in a minute that the prime now has been given 120 days instead of 90 days to provide all the closeout information. And it makes absolute sense that the subrecipient has basically 90 days because the sub is under the prime. The prime needs to have at least 30 days, which is really good that they're giving them an extra 30 days to take the data from the sub and then, you know, process everything and work the things out that need to be worked out. And so I've seen this as an issue. When you make both 90 days, the only way that the authority is through their subaward agreement, they'd have to say, well, knock that back to 60 days because we need 30 days. But here they're actually putting it into the regulation. So it's very important if you're a pass-through entity, as you can see, both with management decisions, with oversight of your subs, there's a lot of things you need to be doing and a lot of things you need to build into your subaward agreements. And lastly, as far as liquidating or closing out all your payments and everything, you have 120 days after the date of the period of performance. And that is a solid date, whatever that literal date is. It's not business days, it's literal days of the week. When it comes to 120, if it's 121 and you didn't close it out, it's too late. You're not going to get forgiveness. I've seen this happen. It's an ugly situation. Used to be 90, so they're being a little bit more generous with the time, but you really need to take those deadlines serious. And then for those entities that don't submit the reports within a year, you know, that is where the FAPIS system, you know, gets into designated integrity and performance system. So, and then also they have enforcement actions under 339. So, you don't want to get in trouble with the government. You don't want to get suspended or debarred. Interestingly, they did add something at the end that says even, you know, after basically post closeouts, that means it's closed, there could be an adjustment for resolving indirect cost payments and, you know, and other final payments. And so one would hope that it doesn't just is a one way, where if the government finds that there's some rate variance and they want that money back, but also let's hopefully it's the other way. Whereas if you have resources that's still left on the award, but you finally got your rates finally, you know, negotiated and settled, that if there's money due to you, you have to have money available. But if there was money available, you could actually go back and get that money. And now we pretty much get into the last section. And again, we'll try to move this along. I think most people aware of the micro purchase threshold, and that you have, it's basically a $10,000 threshold. But what they get into as we move along in a minute is that you can increase that threshold. And here is the threshold for the simplified acquisition threshold. But here they're saying, well, in the prior one for the micro purchase threshold, they're saying, but you could increase it. And in this definition, they're saying, but you could reduce it, but you can't reduce it without being authorized, and it cannot conflict with state governments, which we'll talk about in a minute. And they're just basically saying, this is a responsibility of you to look at your simplified acquisition threshold, simplified, and based on internal controls, evaluation of risk, and so forth, you can adjust. Because a lot of small entities, $250,000 threshold is pretty high. And so they may, for their own purposes, and that is the threshold between which we'll talk about in a minute, informal and formal, or competition or no competition. And so basically nonprofits that have, or entities that are small, they don't want it to be as high as 250,000. I've seen some make it as low as 5,000. So they've added some statements again to really reinforce things, the use of documented procurement procedures, document. As one auditor used to say, if it's not in the file, it isn't. So the federal entities' documented procurement procedures must conform to your procurement standards. And again, they're punctuating things, I'm sure, because as Tricia has said, they've got a lot of feedback from auditors and some issues, and now it's time to basically memorialize that. Even competition is dealing with procurement transactions. So again, they're punctuating that this is for the acquisition of property or services. These are not subawards.
And Paul, one of the other things that I just wanted to also highlight here specifically relative to procurement is that they have to be uniformly applied. So when we talk about procurement, I see a lot of organizations who have a specific policy surrounding federal funding, and then they have another policy that's a little different when they have other types of transactions that aren't federally funded. But the uniform guidance is very clear that things must be uniformly applied. And we take that quite literally, meaning that if you have a policy that's in place for the federal funding, you need to have that same policy in place for all of your other transactions. So if you set a policy over here for the federal funding that says that you have to have a quote or a bid for anything, let's say above that $5,000 instead of the micro purchase threshold of 10 that it's currently set at, then you have to do the same thing for all of your non-federally funded transactions as well. And that is something that we as auditors are looking at as far as compliance goes, to make sure that everything, again, is uniformly applied. And specifically around procurement, I've seen a lot of organizations who have not well documented a couple of different things. They've documented well the different types of thresholds, the micro purchase, the small acquisition threshold, et cetera, but they've not documented well what their sole source justification process is. So from my perspective as an auditor and what I've seen so far, even, almost 4 years now at this point, uniform guidance being into play, sole source justification is just as important as well, as far as that policy goes. And again, policy, if it's not written, if it's not documented, I can't audit.
There you go. So the informal procurement methods, again, is a threshold that's obviously lower than the simplified acquisition threshold. And they're trying to just basically group things, because under the simplified acquisition threshold for competition, which is 250,000, you're either going to have micro purchase threshold or purchase procedures that's between 10,000 and 250,000. And they made some minor changes to, if you're in the micro purchase threshold, to distribute it, among qualified suppliers, which I don't want to spend a lot of time on. But again, they're talking about, again, for even the micro purchase threshold, that their internal controls, evaluation of risk, and its documented procurement procedures. So basically, you're going to see at some point, they are allowed to increase the micro purchase threshold to $50,000. And there's an opportunity to self-certify that, or the government has an opportunity at any time to look at that. And you can see, if you're gonna do this, you're gonna say, hey, well, we're low risk. We have an annual internal institutional risk assessment, which is interesting. That's kind of new. And public institutions hire a threshold consistent with state law. And there's even ability to go above the 50,000. But again, these are things that are going to have to be justified, and justified quite a bit. So we were kind of running down with time. And so what I'd like to do is, the one purpose here is that when it talks about small purchase procedures, it's always been unclear as far as the adequate number of qualified sources as determined and appropriate by law. And what basically they're saying here is, the entity determined the appropriate level for a non-federal entity, rather than the government coming up with some idea. And probably the number for qualified sources may be 3, as often is used. Again, the government, which is nice, is documenting that the entity, can determine that, because it's very, it's something that's just so unclear. And they're trying to help you a little bit with that.
And the auditor would say 3 is a very good number. I argue that 2 is not enough. And the reason being is because you could get one bid that's really low, one bid that's really high. It doesn't give you a nice place to really make a good judgment on decision. So if you get one more, it'll give you a wider range to be able to make a better judgment.
Very good. So, and again, it gets into the formal procurement methods, and that would be the level of the simplified acquisition threshold. What I may have skipped over, which I would just briefly mention, is should you want to reduce your simplified acquisition threshold. Again, the government wants some form of formal approval, and as long as it isn't in non-compliance with a state or local law. And then they're talking here about formal procurement methods may require, or it does require, public advertising. The 2 kinds that are basically under competition that are above the $250,000 threshold is these are sealed bids, which is like an invitation for bid. It's fixed price sum, and it's usually awarded to the lowest bidder, or procurement by competitive proposals. We're not actually going into that. We're just trying to show you what is there. And exactly what Tricia had come up with is, when do you apply the level for sole source? In the past, the government did not put anything in that dealt with, well, what's the minimum level? But now they're saying that basically the micro purchase threshold, what they're saying is that dollar amount which does not exceed it can be considered, for sole source automatically. I used to share with potential clients that 10,000 would be something you could put in your requirements for this. Do you think this helps some, Tricia, as far as a minimum level for it?
I do, but the other thing that I kind of want to touch on really quickly is that you have, again, that's that very key word in that phrase that you've highlighted there, which is aggregate, right? So we're not talking about one transaction. We're not talking about one invoice, one payment, one particular service. If you contract with a vendor over a certain period of time, right, it's in aggregate. So I just want to highlight that as well to make sure that that's, hit on.
So maybe it's vendor by vendor transactions is what you're saying?
Vendor by vendor transactions. I'm talking about, so if you have one vendor and you are getting a service provided for them, let's say once a quarter, and each quarter that service is only $7,500, but you times that by 4, you're now over that micro purchase threshold. So you want to be very clear that that falls into the realm of A, either you have to get a quota bid, or B, you have to do a sole source justification. And I want to make clear also that the sole source justification really is something I think that has to have a really good understanding of what that means. Nobody in your region can provide a similar service for you, right? There can't be anyone else out there that has the same skill set to be able to provide it to you. There are specific requirements over what a sole source justification actually is. They have to be the only person or the only vendor that can provide that for you.
That's right. And should you want a sample, we have some sample forms. So we're always happy to share that kind of information. That's correct. Oh, here we go. The last polling question.
Yep, perfect, Paul. So yeah, before we start wrapping up, just want to make sure everybody gets the final CPE word and credit. So our last polling question is, based on the numerous changes to procurement standards, my organization will address a revision and upgrade to our SOP for federal awards. Is it A, only when our awards exceed $750,000 in incurred costs per year? B, sometime in the future, as we would do a rewrite in-house? C, in-house, as we have had bad experiences with outside consultants? D, since it's a significant impact on our procurement procedures as well as other aspects of our grants manual, we plan to put out an RFP for services in the near future? E, since we view this revision as an immediate compliance requirement, we're open to unsolicited proposals to assist with an upgrade to our grants manual? Or F, I just don't know, as we don't have the internal experience nor the funds to utilize an outside expert. So while everybody's recording their responses, I'm going to provide the last CPE word you'll need. And the last CPE word is acquisition. Again, just a reminder, you're going to need the 2 words I provided previously, as well as this word, to receive full CPE credit for our webinar. Again, the last CPE word is acquisition. ACQUISITION.
We appreciate the feedback on that, and it gives you also an idea of where other entities and how they're dealing with. So we hope that that information is helpful to you as it's helpful for us. Basically, the last item that's worth addressing is a very important change. If you previously had negotiated indirect rate and you find for whatever reason, or there's been a lapse since you've had a negotiated indirect rate, and you now wish to use the 10% de minimis rate, there has been a change to that, and that you're now allowed to use the 10% de minimis rate, even though you may have had negotiated indirect rates, but it would be the 10% indirect de minimis rate can only be used in the new period, not back to a prior period, but it can be used in the new period. And of course, no documentation is required. The last thing we just want to present to you is that it looks like now that the OMB is going to designate a federal website where your negotiated rates, those of you who have them, your distribution base, and your rate type, like predetermined or final or provisional, will actually be loaded on there. I do not know when that will happen, but that's one of the last things. So we're just wrapping things up. If you have any questions, I'll turn it back over.
Sure. Thanks, Paul. I think we have time just for one quick clarification question. So let me just be clear. So subrecipients that have no directly funded federal awards, only through PTEs, so they're unable to obtain a negotiated indirect cost rate directly from a federal agency?
Yes, unfortunately.
Okay.
And in fact, it's a good point you just mentioned, but real quickly, one of our clients asked us, and we wrote a letter to HHS or together, and HHS said absolutely not, because they're a subrecipient, even though they had over $15 million in pass-through awards, but because they have no one prime award, they could not have a negotiated indirect rate.
Got it. Okay. Thanks, Paul. Thanks for clarifying that. And again, just a reminder to the participants, if there's any other questions you have, we weren't able to get to all of them, I think. So just reach out to us. The contact information is listed here. And so with that, I'd like to thank everybody for attending. And as always, we encourage you to follow us on social media at grfcpas.com and visit our website for any upcoming events and alerts. And that website is www.grfcpa.com. So again, final reminder, remember to complete the emailed survey that's going to follow after our webinar if you'd like to receive CPE credit. And as always, thank you for attending and have a great day.